Thank you, ladies and gentlemen. Good morning. Thank you for joining me. Thank you to Cambridge House for having me here. I appreciate everything you guys are doing here. We're going to talk State of the Resource Markets 2020. There's going to be some information here that you won't see anywhere else. The way that we present data here, it's a focus on technical analysis, which means studying price foremost. And if you really think about it, if you really ask yourself truly what is most important to you as an investor, it's probably the price of the assets that you are investing in. So that's what we're going to get into. Price analysis of the resource markets, what is shaping up for the 2020s. My name is Christopher Aaron. At iGold Advisor, we invest in resource companies. We have a growing list of retail investors that invest with us. And I also represent certain high net worth individuals. We take positions in companies. We look to make significant gains on those companies within a 1 to 3 year time frame. Steins Law. Who is this guy? Herbert Stein, American economist of the 20th century. What does Steins Law say? That which cannot continue forever will one day stop. And it seems kind of basic, it seems like, well, of course. But I have to tell you, when you're analyzing the markets and things get really complicated, everyone telling you all sorts of different things, if you come back to the most basic principles, you will find time and time again throughout your career, these are the things that bring you to the next level, relying on these basic principles. Let's apply Steins Law to the resource markets. How are we going to do this? That which cannot fall to zero, okay? So that which cannot continue forever, let's say that which cannot fall to zero, yet which is the closest to zero that it has ever been. What could some things like that be? They are very, very close to home right here, because on the bottom we are talking about the sum of the commodity sector, and on the top of this graph we are talking about the resource companies that are here at this conference that are digging these materials, these resources out of the ground. This is a 20-year chart. Both the sum of 19 commodities as represented by the CRB commodity index and the companies digging these resources out of the ground are the closest to zero that they have ever been. In modern history, when we're talking about the CRB, this is a 20-year chart, but we'll extend this back to 1975 so you can really see what I'm talking about. Closest to zero that they've ever been, but they can't go to zero. It's like, there's an opportunity here. What is the opportunity? It's not going to play out as easily as many people, I believe some of my colleagues, are believing. I think it's going to be a lot more volatile. There are going to be a lot more ups and downs, but still excellent, amazing opportunities setting up throughout the next decade if you know how to manage this. So on the bottom, when we look at the commodities, now it makes sense that these charts look similar, right? If you look at that 2007, 2008 peak in the commodity sector, and then you look at how it fell in the crash of 2008, and you look at the same thing that happened in the Canadian Venture Exchange on top, and then the recovery into 2011, it makes sense that these charts look very similar. Why is that? Well, they're intrinsically related. Look at the makeup of the Canadian Venture Exchange. You have almost 60% of the Canadian venture that is involved in materials, utilities, and energy. Intrinsically related. What is the pattern? Some of our investors that are here, you will know already what I'm talking about. What is the pattern that's shaping up in the commodity sector? It is this thing shown in blue. We're talking about price analysis. Strip away all the fundamentals. What is actually happening in the market is a terminal wedge, a 12-year terminal wedge bottoming pattern. This is a pattern where we can see the highs from that 2008 high. Where are the sellers showing up? They're showing up at a very steep slope coming down. The sellers are showing up, they're showing up, they're showing up. But the buyers along the lower edge of this pattern are showing up at a relatively less steep slope. And these buyers and these sellers are converging. And because the sellers are converging, they're coming in at relatively higher intervals as per the slope than the sellers. This is a pattern which shows us that a bottom is forming in the entire resource markets after a 12-year bear market. These kinds of things don't happen every other year or every 5 years. This is a decade-plus bear market, and something interesting is about to happen here. Now, the problem is that this is not going to transition just into a new bull market like we saw in the 2000s. You know, when oil went from $12 a barrel to $150, when natural gas went from $2.75 up to $15. This is not going to happen again quite so quickly. And we will look at the fundamental reasons for this why in just a moment. But that is the pattern that is shaping up, and we see the exact same pattern. And notice this broke just 2 years ago. Exact same patterns that has set up in the Canadian Venture Exchange. The fact that we saw that break of the upper boundary of the terminal wedge, and then stock prices have drifted back into that multi-decade support zone, shows us exactly what this pattern means. It shows us that a market is transitioning from a bear market into a stable market. That is the next phase before the next bull market can emerge. Let's take a giant step back here and think about generationally low commodity prices and why this has happened and what this really means for us as a species. There is an upward march of progress. We are all part of it. The fact that you are all here, which just 100 years ago, this wouldn't have been possible to get on a plane and come attend this conference. The fact that some of you may have found me online on YouTube, just 12 years ago, YouTube was not powerful enough to carry any of these videos on broadband. There's an upward march of progress where we get more efficient as a species at extracting resources out of the ground. This has been going on since the dawn of time. You think about other markets where there is no government interference. Think about flat screen televisions. You know, a flat screen like this, purchased 15 years ago, would have cost $10,000. You had to take out a second mortgage or a loan to buy a flat screen TV. When governments don't meddle in markets, what happens? Prices come down. The natural state of prices, because we as a species get more and more efficient, is for deflation to happen in prices. And this goes for commodities too. It's not a negative thing, it's a positive thing. So our efficiency as a species acts to bring prices down. On the flip side, and this is what a lot of resource investors focus on, especially in the precious metals, is the meddling in our economy by the central banks. The printing of money, the bailouts, the bail-ins, bailing out Citibank. And then the other one, which is close to home for me, is war, which is not only inflation for the sake of inflation, but it's a double inflation because then the products of war are taken and they are blown up on the other side of the planet. And so a lot of resource investors correctly identify these trends. And they say, commodity prices are real tangible things. We can't make more oil as far as we know. But I believe that commodity investors as a sum are overlooking the upward march of progress, which serves to bring prices down over time. And if you think I'm just pulling stuff out of thin air, let's look at this. All time in the history of mankind, supply records being broken here just in the last year. This is world liquid hydrocarbon production in billions of metric tons per year. 2018 is the last full year that we have data for. 4.5 billion metric tons pulled out of the ground. That is a 36% increase over the last generation. The theory of peak oil, it sounds great on paper. There's some evidence to support it, but we see no empirical data that this is playing out at any time that's going to impact us as investors. We get more and more efficient at extracting resources from the ground. Look at Texas. Oil production coming out of Texas almost tripling in the last 20 years. If you think that's impressive, look at North Dakota. up in the last 20 years alone 1,225%. They went from producing next to nothing 10 years ago, and due to shale and fracking technologies, now producing almost half the amount of oil as Texas, which has been mining for the stuff for the last 130 years. Or drilling for it, excuse me. It's not just oil, it's gold. Look at gold. Production, mine production for the last 10 years, not only up 25%, but the last year that we have data for, within the next few months, we'll have closing end 2019 data. We pulled, as a species, all of our collective efforts. You as consumers, you as investors contributed to this. We pulled more gold out of the Earth's crust than at any other point in 5,000 years of using gold, just in 2018. So I hope I've made my point clear here. When we look across the resource spectrum, we have gotten very, very good at pulling these resources out of the ground. This represents a challenge for investors over the short run, but it's beneficial for us even as investors and especially as citizens of the world over the long run. What happens next? There's that terminal wedge bottoming pattern. We have a map for what to expect next. It's not going to be as easy as a new bull market, but here's what is going to happen on a highest probability scenario. When we look at how these cycles play out over and over and over again throughout history, because the resource markets are cyclical. New supply is now coming online. We've seen it. It's going to take time for industry and us as human citizens to use that supply. And so when you see, as you saw in 1987, a break of a terminal wedge pattern, what happened? It was not a new bull market immediately. The market had a first initial pop, a nice 10 or 20% pop there in 1987, 88, and then what? It drifted back down, another cyclical advance, drifted back down. Overall, 17 years of sideways price action. We now have a bear market that is just ending, which was longer than the bear market after 1980. So I propose to you that the surge, which is about to happen, and by the way, if you go back onto the VRIC website and pull up my talk from last year, I was talking about this. We had not yet broken that wedge pattern, but I was alerting people that this surge in commodities, this initial surge, is getting ready to happen. And here we are seeing it happen. The initial surge, we're breaking this pattern, is going to be a little bit anticlimactic. It's going to be sold. Why? We are not done with the supply increases. The buying that's coming in right now is going to be flooded with supply late 2020 into 2021. Prices are going to come back down. There's going to be another surge. New supply is going to come back on. We are going to have these cyclical bull and bear markets well into the next decade, each one of which could see these small cap companies rise 100, 200, 300, 500%, and then give all of those gains back. And through this process, these cyclical booms and busts, through this process, the wheat is going to be separated from the chaff in the resource markets until what? A true bull market will emerge once industry has used that excess supply. A true bull market will emerge, most likely late 2020s into the 2030s. So there are going to be opportunities for profiting the entire way, up and down, but it's not going to be as easy as just buying as we did in 2003, waiting for the next 6 years as everything rises higher together. It's not going to be quite that easy. Just bringing that back, we just looked at this with the commodity index on the bottom, bringing it back to the Canadian Venture Exchange. 90% here of the companies that are at this conference are Canadian Venture Exchange companies. There are index funds that buy and sell Canadian venture companies across the board. And they get pulled up and they get pulled down together. Unfortunately, it's rare when you have a bear market in the Canadian Venture Exchange for a single company to be able to outperform. One or two may do it. And bless them, congratulations. The vast majority are going to get pulled with the broad indices here. There's going to be these cyclical booms and busts as supply is worked off. It's going to be an excellent time for those that have a decade or two ahead of themselves in the resource markets to get positioned, to profit. and then we're going to have a true bull market emerging perhaps a decade later. So one investment idea. Let's talk about one practical idea that I believe you can implement now. This should be good for the next 1 to 3 years. We're looking from 1980 to the present. On the top is the platinum to palladium ratio, these two other precious metals. How many ounces of palladium does it take to buy 1 ounce of platinum? Look at where we are right now. Remember Steins Law. That which cannot continue forever will one day stop. This is the closest to zero that this ratio has ever been. There's only one other data point. That was back in 2001. 20 years later, we are at the same point. What happened in 2001? Follow the green shading downward. Palladium had this major move. It was up about 500% in the previous 3 years. Platinum had barely gotten off of its bear market lows, its 20-year lows. After we saw that ratio bottom near 0.5, what happened? Palladium lost 85% of its value over the next 4 years. Platinum gained 270% over the next 7 years. These things completely reversed. We are at the exact same point in this ratio today. So, I'm not saying that palladium can't go a little bit higher. Maybe it goes to 2,500. Maybe it goes to 3,000 in a real blow-off move. Risk to reward, this is not the time to be chasing either the physical metal palladium, unless you're a very short-term trader, nor palladium-focused mining companies. What you should be doing is averaging your way into a basket of platinum mining companies at this point, because the only other time this signal has shown up in all of modern history, post-Bretton Woods Accord, this has been a major signal, and there are fundamental reasons why this kind of thing happens. Substitution in industry is a real risk. Trust me, companies will find ways when the price of one metal gets too expensive to substitute another metal. Investors will come in. If you can buy 2 ounces of platinum versus 1 ounce of palladium, we as investors have a decision to make there. Speculators will fill in the gap. 1 to 3 year time frame, I would say this is the time over the next several months. You might want to wait a month or two for a bit of a correction here. This is the time to be looking at platinum producers for a nice surge over the next 1 to 3 years. The executive summary, state of the resource markets for 2020. The following markets cannot go to zero. Steins Law says that, yet these are the closest to zero that they have ever been in modern history. We're talking about the sum of the commodity index. We are talking about all of the valuations of the companies that are here at this conference. We are talking about the platinum to palladium ratio. There are major opportunities across these if you select and choose wisely. Despite those horrible drags from central banks and from war makers on our collective efforts as human beings, despite that, we as citizens of this planet, we are getting more efficient at producing and extracting resources. We're getting more efficient at everything that we do. This is a good thing, even though it represents these challenges / opportunities here in the resource markets for us. It does create these supply overhangs. They last for 1 to 2 decades. There is a pattern for how this will play out, and this is how it's going to play out. In the 2020s, there are going to be these cyclical 1 to 3 year bull and bear markets as supply and demand come into equilibrium. We must accumulate high quality positions, and we must be willing to take profits on those positions into these cyclical advances. And then what's the hardest thing in the entire investing world is to wait. We are going to have to wait for the markets to retrace and then redeploy those profits. This is going to be the key to successful investing in the resource markets in the 2020s until that next true bull market arrives. Thank you very much for watching, and I just want to encourage you to think about that law and how it applies to the markets. Steins Law predicted this. The time to prepare for the next cycle is now. Thank you.